Hello traders, welcome back to part 2 of our series on trading with this specific indicator setup on the USDJPY pair in 1 minute time frame. If you haven't seen the first video, make sure to check it out in the playlist before continuing. This indicator is particularly effective for trend traders. I strongly recommend traders focusing on JPY pairs to follow the trend or rely on this indicator. Let's dive into today's trades. First trade of the day, I've entered a long position because the EMA lines are in the optimal order 50, 100, then 200. This arrangement suggests an upward price movement. Additionally, the trend line stop is green and the stochastic is below the 20 zone. We enter at the EMA lines, set the stop loss below the trend line stop, and aim for a 1-to-2 risk-reward ratio. This long trade played out nicely. For the second trade, the stochastic level is below 20 and EMA lines are favorable. Our indicator shows a key zone. We enter a long position from the 50 EMA line, set the stop loss below the key zone, and target a profit twice that distance. Next trade follows the same rules. Enter long, stop loss below the key zone. Take profit at twice the risk. This one didn't work out, but that's perfectly normal. Losses are part of trading. For this trade, I entered a short position because the price broke resistance and formed what looked like a head and shoulder pattern. This trade also failed, which is okay. It's important to remember that not every trade will be successful. The next long entry was quickly abandoned when the trend line stop changed direction, so always stay alert to shifting indicators. Our sixth trade was a short entry from the 200 EMA line. The trend line stop was bearish and we saw a death cross of the 50 and 100 EMA lines. We anticipated a break of the key zone. The price rejection at the key zone validated the indicator's effectiveness. Another short entry followed as the price retraced from the key zone, but the trend line remained bearish. Stop loss was set at the lower high, with take profit at twice that distance. These two trades were very successful. Next trade was very straightforward, shorting from a retracement to the resistance level, with bearish EMA line confirmation. Here we see the price break strongly above the 200 EMA line. I seized this opportunity to enter a long position on the retracement. Notice that the trend line stop has turned green, giving us additional confidence. We set our stop loss just below the trend stop line and aim for a take profit at twice the distance. The strategy maintains our consistent risk to reward ratio. Remember, while this indicator setup can be very powerful, it's crucial to always practice proper risk management and remain adaptable to changing market conditions. In the next two trades, I faced what traders often call a double slap, 2 consecutive losing trades. However, thanks to the early exit conditions signaled by our indicator, I managed to limit the losses to just 5 pips. This underscores a critical point: always stay alert and responsive to changes in the indicator signal. These signals aren't just for entries, they can also guide us on when to exit a trade to minimize the losses. This experience highlights the importance of not just using the indicators for entry points, but also for managing ongoing trades. By staying focused on dynamic nature of these signals, we can often avoid larger drawdowns and protect our trading capital. As we wrap up this video, I hope you've gained valuable insights into how this indicator setup can be used effectively in real-time trading scenarios. Remember, consistency and discipline in following your trading plans are key to long-term success. Keep practicing, stay alert, and never stop learning. Until next time, happy trading.